and that is accrual accounting. And the basic reason from a reporting standpoint that accrual accounting is used by every large organization, every listed or public organization, and any organization where inventory is a very large component of the overall business is the government requires it in most countries because on an ongoing basis, it's more accurate. How is it more accurate? Well, remember with cash accounting, we calculate costs as we pay them and revenue as we receive it. Under accrual accounting, we count the revenue when the transaction is completed, not when the cash changes hands. So whether we're making a sale or receiving payment, the timing of the cash transaction, which of course under cash accounting might be creative, under accrual accounting it's more straightforward. So here's an example. Today you make a sale. You sell something for £1,000. Even though you may not plan to get paid for that for 15 or 30 or 60 days, you record that sale today. If you don't receive cash, and many of us do not, we record an accounts receivable on the balance sheet. We'll go back to the matching principle we talked about earlier. Here again, we're matching revenue with a receivable. We made a sale for $1,000. We did not receive the cash today, but we need some offset. We need some way to balance this. So on our balance sheet, we show that a customer owes us $1,000 that they will pay in the future. So the accounts receivable on the balance sheet matches the revenue on the income statement. This way, at any point in time, anyone, both internally and externally, can look at the financial statements and understand what sales we've made, what costs we have incurred, not paid, but incurred. They can look at the balance sheet and recognize of all the sales we've made recorded on the income statement, what has yet to be collected? Our accounts receivable on the balance sheet. Of all of the costs on the income statement, which ones have we not paid yet? That would be the accounts payable on the balance sheet. So again, we go back to the balancing, the matching principle. The real purpose of accrual accounting is to make sure that on an ongoing basis, anyone can look at our financial statements at any point in time and get a reasonably accurate picture of where the business is. Now, some of you may be thinking, well, what about the cash? Well, this is why we have 3 different financial statements that we'll be reviewing in the next few modules. The income statement is going to record our revenue and expense. The balance sheet records our assets, what we own, our liabilities, what we owe, and the difference, which is owner's equity. And the cash flow statement calculates cash in and cash out. The 3 of them each do something different, but are linked. We'll see this as we move forward. So, cash accounting is literally recording our cash as it flows in and out. Accrual accounting records more accurately at any point in time what the sales versus costs are. And that's very important for us to recognize over time. Now, the principle of book value versus market value is a very easy one to understand if we recognize that the purpose of the financial statements, again, going back to where we started with being conservative and the cost principle, the purpose of the balance sheet specifically is to record our assets, things we own, at what we paid for them, less any accounting reduction. And we'll see this in a very specific transaction when we get into the balance sheet. That's called the book value. What did we pay for something? What is it worth from an accounting approach today? So we'll go back to acquiring a piece of equipment, $10,000. We acquire it 2014. It has a 10-year life. Accounting is going to allow us to depreciate, to recover $1,000 per year of that cost. So we buy it for $10,000. At the end of the first year, we will depreciate it or reduce the value by $1,000. At the end of the second year, another $1,000. At the end of the third year, another $1,000. So if we pay $10,000 for it, 3 years later, based on this example, the book value would show $7,000. What's it really worth? Accounting doesn't care. That's not the purpose of accounting. What it might be worth in the marketplace, what we could sell it for, is where we look at market value. Market value is what we think we could get or receive if we were to sell it in the marketplace. That changes over time. We certainly have seen over the last few years values increase and decrease on many things, from businesses themselves to the assets they have to certain industries. Market values go up and market values go down. Accounting doesn't concern itself with market value. That's not its purpose. Market value is important as we're looking to either buy or sell something. For those decisions, very important. But for accounting, for our financial statements, it is not important. So if you're looking to acquire something or sell something, you're interested in market value. And you'll make your decision, should you buy it, should you sell it, based on the relative value to you, what we call an arm's length transaction. But for our financial reporting purposes, we look at book value. Again, going back to the cost principle and being conservative. Now let's talk about the difference between profits and cash flow. And unfortunately, frequently these terms are used as if they're the same thing. To be clear, profits are an accounting result. They may or may not be the same thing as our cash flow in a given period. So we measure profit as the difference between our revenue or sales, that's what's coming into the organization, versus our cost or expenses. So if we have $1 million revenue for the period and $900,000 in costs, we'll have $100,000 in profit. Where's the cash? Well, we'd have to look at the financial statements, specifically the cash flow statement and the balance sheet, to know where the cash is. Because even though we had $1 million in revenue, $900,000 in expense, the $100,000 in profit might be in cash, might have been invested in some asset, might be currently tied up in accounts receivable. That's yet to be determined. So that's our profit. Cash flow is measured as the difference between the cash received, also called the inflows or the sources, and the cash going out, called the outflows or the uses. So this is why we have to look at the cash flow statement to say what cash came in, where did we use it, what cash went out, how much cash did we start with, how much cash is left. So cash is important in every organization, but it's not the same as profits. Think of it this way. Revenue minus expense is profit. That's an accounting number. Cash in, cash out, net cash is real cash. But we can't know if they are the same in any one period until we look at the various financial statements. And we will do that in the coming modules. Now, here's a quick example. Back in 2008, in the Great Recession, most of the world's airliners lost millions and millions of dollars because revenue dropped significantly for a period of time. And yet most of them had cash flow to continue. And as you will see when we start to look at the non-cash deductions, that was primarily generated through something called depreciation. Depreciation, as we'll look into in more detail, is an accounting way to recapture a previous period's expense. So cash flow is generated from non-cash deductions, as we will see, to allow some organizations actually create more cash than they use, even though they report correctly and accurately profits that are negative, also called a loss.